Hello everyone, my name is Megan and I will be presenting on bond valuation and interest rate sensitivity. Today, we will be comparing two bonds, A and B. These bonds have the same credit rating, par value, and coupon rate. The key difference is their time to maturity. Bond A has 30 years until maturity, while bond B has only 5 years. Let's address our first questions. Which bond would trade at a higher price in the market? My answer would be bond B. With its shorter 5-year maturity, is likely to trade at a higher price. This is because shorter term bonds carry less interest rate risk. As Babozzi notes, the longer the time to maturity, the greater is the interest rate risk. Investors typically demand a lower yield for shorter maturities, which translate to a higher bond price. Remember, bond prices and yields more inversely. Now, what happens if interest rates in the economy rise? Both bond prices will decrease, but bond A, which with its longer 30-year maturity, will see a more significant price drop. This is due to the greater interest rate sensitivity of long-term bonds. When new bonds are issued at higher interest rates, existing bonds with lower rates become less attractive, causing their prices to fall to compensate. Building on these, we can say that bond A will experience a larger percentage price change. This is due to its longer duration, which is a measure of the bond's sensitivity to interest rate changes. Long-term bonds have higher duration, making their prices more responsive to interest rate fluctuation. Let's illustrate this with a numerical example. Assume both bonds have a 5% coupon, $1,000 per value, and the initial yield to maturity is also 5%. At these rates, both bonds will be priced at par or $1,000. Now, if interest rates increase by 1%, bond A's price will fall to $853.16, a 14.68% decrease. Bond B's price will only fall to $957.35, just a 4.226% decrease. This clearly demonstrates the higher interest rate sensitivity of the long-term bond. Now, let's consider an investment strategy if we expect an economic slowdown in the next 12 months. Typically, in a slowdown, interest rates tend to fall as central banks try to stimulate the economy. In this scenario, an investor might consider buying long-term bonds to benefit from potential price appreciation as rate fall. Raleigh and Brown points out that in a recessionary environment, high-quality bonds tend to outperform stocks. This strategy also allows investors to lock in higher yields before rates potentially decrease. To summarize our key points, longer-term bonds are more sensitive to interest rate changes, which means they carry higher risk, but also offer higher potential returns. It's crucial to match bond maturities to your investment time horizon. and always consider the broader economic outlook when crafting your bond investment strategy. These are the primary sources I have used in preparing this presentation. The concepts we have discussed are fundamental to bond investing and cover in depth in these textbooks. Thank you for listening.